종이만 만집니다. 창문에 맺힌 바람 내 마음을 스치고 돌아오지 못한 길 또 한 번만 바라봅니다. 가슴 깊이 숨겨둔 한마디가 남아서 삼킨 눈물 끝에서 자꾸만 그댈 부릅니다. 그대여 돌아와요. 내 숨이 닳기 전에 그대여 돌아와요. 이 밤이 무너지기 전에 사랑아 살아있어. 내 심장에 남아서 그대여 돌아와요. 내 눈물 다 마르기 전에. 비단 옷자락 끝에 묻은 먼지 털며 멀어진 뒷모습을 아직도 놓지 못해요. 빈들의 핀매화는 혼자서도 피는데 어찌하여 내 사랑은 계절을 못 건너가요. 못다한 그 한마디 입술 끝에 맴돌아 차마 닿지 못한 채 오늘도 더 깊어집니다. 그대여 돌아와요. 내 숨이 닳기 전에 그대여 돌아와요. 이 밤이 무너지기 전에 사랑아 살아있어. 내 심장에 남아서 그대여 돌아와요. 내 눈물 다 마르기 전에. 저 문이 열리면 내 전부가 무너져도 한 번만 그대 손을 잡고 싶어. 세월이 되어도 이름은 남아서 끝내지지 못할 이 마음 달빛 아래 타오르네. 그대여 돌아와요. 내 숨이 닳기 전에 그대여 돌아와요. 이 밤이 무너지기 전에 사랑아 살아있어. 내 심장에 남아서 그대여 돌아와요. 내 눈물 다 마르기 전에. 달에 외로운 그림자 하나 서 있네. 그리운 이름 부르며 바람에 묻힌 눈물 닦아내네. 아리랑 고개를 넘어 저 멀리 흐르는 강물 따라 그대의 향기 남은 곳으로 다시는 돌아갈 수 없는 곳. 한 조각 달빛 깨어져 내 손끝에 스미는 차가운 밤. 흐르는 별들 속삭여 내 아픔을 안고 어디로 가나. 가슴에 새긴 약속들 먼지처럼 흩어져 사라지네. 시간이 멈춘 이 자리 그대의 웃음이 나를 삼키네. 아리
판매 성공. 구매 성공. 판매 성공. 구매 성공. 판매 성공. 판매 성공. 판매 성공. 구매 성공. 구매 성공. 판매 성공. 구매 성공. 판매 성공. 구매 성공.
Good afternoon, and thank you for participating in Porch Group's second quarter 2026 conference call. Earlier today, we issued our press release and filed our related Form 8K with SEC. The earnings release and today's presentation are available on our investor relations website at ir.porchgroup.com. Before we begin, I'd like to review the company's safe harbor statement within the meaning of the Private Securities Litigation Reform Act of 1995, which provides important cautions regarding forward-looking statements. Today's discussion, including responses to your questions, reflect management's views as of today, July 29th, 2026. We undertake no obligation to update or revise these remarks. We will make forward-looking statements that involve risk and uncertainties, and actual results may differ materially. Please refer to the information on this slide in our SEC filings for additional detail. We will also reference certain non-GAAP financial measures. Reconciliations to the most directly comparable GAAP measures are included in today's earnings release, available at ir.porchgroup.com. Replay of this webcast will be available shortly after the call, again on our investor relations site. Joining me here today are Matt Ehrlichman, Porch's CEO, Chairman, and Founder, Sean Tabak, Porch's CFO, and Matthew Nagel, Porch's COO. With that, I'll turn the call over to Matt for his key updates.
Thank you, John. Good afternoon, everyone. Should be another fun call here today. We are pleased to report a fantastic second quarter, where we again delivered results that exceeded expectations and are raising guidance substantially across the board. We generated positive net income attributable to Porch in the quarter and expect that to be true for the full year 2026, 2027, and the years ongoing. I was excited to share this. Overall now, with Q2 revenue growth, excluding the reciprocal, at 23%, and adjusted EBITDA margin, excluding the reciprocal, at 30%, we are now a Rule of 50 company. Insurance services, our core, largest, and fastest growing business, stands out even more, with 38% revenue growth and a 48% adjusted EBITDA margin this quarter. Policy growth at our insurance business grew by the same 38% year over year. This is a big deal. Our insurance service business generates its economics based, yes, on reciprocal written premium volume, but also meaningfully based on total number of policies, given the policy fees that are charged to each policyholder. We manage to our financial results based both on premium and policy count, which I'm not sure is fully appreciated. Incremental margins at insurance services are exceptional, which you can see based on the fact that incremental revenues flowed almost fully into higher adjusted EBITDA. For our entire company, adjusted EBITDA, excluding the reciprocal, grew 2.5 times year over year. The progress we've made on profitability is strengthening our balance sheet profile. We're announcing today increased 2026 guidance of $122 million of adjusted EBITDA at the midpoint. This puts our leverage below 3 times this year. The reciprocal is healthier than it's ever been, with statutory surplus growing quarter over quarter and loss ratios that continue to be truly exceptional. So the key message is that the system is working. We built a differentiated insurance platform with strong capacity, expanding distribution, and proprietary data, which creates a fundamental margin advantage relative to competitors. So Q2 results were strong. Sean's going to dive in more deeply momentarily, but quickly, just a few highlights. Reciprocal written premium, or RWP, was $140 million, up 16% year over year. First half RWP landed right in line with our internal targets at the start of the year. We're managing this well toward our $600 million annual target, while sustaining strong margin across the system and doing so in a homeowners insurance market that is healthy but has softened. As I mentioned, written policies were up 38% year over year. These premium and policy volumes helped drive quarterly consolidated revenue of $141 million, up 12% year over year, and our revenue, excluding the reciprocal, of $132 million, up 23% year over year, with continued strong gross margins of 85% for this quarter. RWP flowed through to insurance services adjusted EBITDA at a 32% conversion rate, demonstrating the strong incremental margins of this business. In a new view, RWP flowed through to company adjusted EBITDA, excluding the reciprocal, at a 28% conversion rate. That translated again to overall adjusted EBITDA, excluding the reciprocal, of $39 million, up 2.5 times the prior year period. Q2 showed the earnings power of the model we built, with premium volume certainly translating into high margin earnings. Scaling our insurance business is straightforward. Statutory surplus creates capacity. Top of funnel consists of insurance agencies driving quote volume, and quotes convert to policies written in RWP. Over the next few slides, I'll walk through each piece of the growth engine and why we believe the foundation continues to strengthen. I'll start here with the result, which is the most important metric. In Q2, again, total reciprocal policies written, this is across new and renewal, grew 38% year over year to 59,000. We expect a rapid policy growth rate to continue throughout the year, ramping to more than 70,000 per quarter by year end. We are well ahead of our start of year policy count expectations, with pricing slightly below due to a softer insurance market with competitors lowering prices. While price can move up or down based on market cycles, policy growth is the key, as it's the leading indicator of future growth as premium per renewing customer naturally increases. There's substantial excess capital to support this level of growth. The reciprocal ended Q2 with statutory surplus of $170 million, up meaningfully versus the prior year period. That's a strong outcome, particularly given Q2 is typically the seasonal period in Texas when weather activity most impacts surplus, and we did see some of that this quarter. The $43 million gained over the last year translates to more than $200 million of additional RWP capacity. Overall, the reciprocal's Q2 statutory surplus supports over $800 million of premium, including non-admitted assets, primarily the port shares owned by the reciprocal. It has the ability to support what's approaching $2 billion of premium. Looking ahead, the reciprocal's surplus position gives us plenty of room to support our organic and inorganic growth goals. So with capacity in place, the next driver is top of funnel through independent insurance agencies. We continue to increase the top of funnel with a land and expand strategy. This is a key strategic proof point in the quarter. Producing agency branch locations grew 148% year over year, and quote volumes grew 87% year over year, and increased sequentially for the 7th straight quarter. That means we are significantly expanding the number of opportunities for us to win attractive, low-risk business. The distribution engine is expanding and quote volumes continue to build, which sets a strong foundation for sustained premium growth. Looking ahead, we have a fraction of the total agencies, even in our largest markets, so we certainly are in the early innings here. Moving down the funnel, conversion is the lever that turns quote volume into new customers and premium. As shown here, conversion remained meaningfully above prior year levels, but we thought it would be helpful to see the impact when we refer to a softer market and how we can respond given our margin advantages. As you can see here, conversion stepped down a tick in May without actions on our side, simply due to competitors being more aggressive in their pricing, likely due to lower reinsurance costs. We responded with targeted pricing adjustments in specific areas, which resulted in improvements and re-acceleration of conversion rates in June. In Texas, our largest state, conversion reached high water marks in the final week of June, with broad-based improvement across the areas where we focus our actions. So the risk for us is less about managing to our medium and even short-term growth goals. In fact, we have a big advantage in our ability to perform across market cycles. The risk is simply in a given month, the execution and filing time required. The fact that we deliver these results in this market with premium per new customer only down 4% year over year in Q2 means that we are sustaining the well above market margins that we've demonstrated. So put all that together, we continue to see strong growth in RWP from new customers, which more than tripled year over year. We're adding new customers at a rapid rate, building a larger renewal base, and keeping premium per new customer relatively stable. With that, I'll turn it over to Sean to cover the financials and guidance.
Thank you, Matt. Good afternoon, everyone. One quick housekeeping item before I dive into the results. Following feedback, we've updated our reporting format to provide more detail on our consolidated GAAP results, which include the reciprocal. We've also renamed Porch shareholder interest to Porch owned segments for revenue, gross profit, and adjusted EBITDA, excluding the reciprocal. We've done that to ensure clarity, and this is a naming change only. Now let's dive into the results. I'll start off with a high-level summary of our financials. In Q2, we saw strong results from the insurance services segment, which drove significant growth in adjusted EBITDA. Policies written of 59,000 were up 38% year over year, driven by new customer additions. RWP of $140 million drove adjusted EBITDA, excluding the reciprocal, of $39 million. That's growth of 150% year over year. Net income attributable to Porch shareholders was $6 million, an important milestone for the business. Overall, these results highlight the strong growth in our insurance services business and its operating leverage as RWP and policies scale. As our insurance services business has grown, it's become the clear engine of our earnings growth, and as such, we'll highlight its performance in today's discussion. Now let's walk through revenue before we move into the segment results. Total consolidated GAAP revenue was $141 million, up 12% year over year. Revenue for the Porch-owned segments, excluding the reciprocal, was $132 million, up 23% year over year. And within that, insurance services delivered $93 million in revenue, up 38% year over year. And now let's dive into the segment results. Insurance services is the segment driving the majority of our adjusted EBITDA and adjusted EBITDA growth. Revenue grew 38% year over year to $93 million, driven by higher fee-based revenue with higher policies written, RWP volume, and new customer additions. In the quarter, we saw 38% growth in policies written year over year, which was a 500 basis point acceleration from the Q1 growth rate. Gross profit was $81 million, up 40% year over year. Gross margins in this segment are strong and predictable at 87% for Q2. Insurance services adjusted EBITDA was $44 million, up 126% year over year. Adjusted EBITDA margin was 48%, compared to 29% in the prior year period, driven by operating leverage as RWP and policies written scale. Two notes here. First, as a reminder, the majority of the high margin management fee we charge is recognized up front, but a portion is deferred over 18 months. Thus, while last year was year one of operating the reciprocal, 2026 is the first year where we benefit from that deferred revenue and corresponding margin. Second, the margin improvement also reflects a roughly $3 million benefit from an expense true-up in the quarter, which we don't expect to recur. Overall, insurance services continues to demonstrate a very high margin profile with even higher incremental margins, given the largely fixed cost base. Shifting now to software and data and consumer services segments, which overall were relatively flat year over year against the backdrop of a stagnant U.S. housing market. Starting with software and data, revenue was $23 million. As a reminder, we sunset certain legacy home contractor SMB-focused products, which drove the year-over-year decline. Our inspection and title insurance software businesses remain solid despite the stagnant housing market. Gross profit was $17 million with gross margin of 75%. Adjusted EBITDA was $5 million. Moving to consumer services, revenue was $18 million. Gross profit was $15 million with gross margin of 84%, and adjusted EBITDA was $3 million. Turning to the reciprocal now, statutory surplus was better than our expectations, ending the period at $170 million, up 33% year over year and up 3% quarter over quarter. This is a strong result as the reciprocal typically incurs the most weather claims in Q2, including a $14 million storm in the quarter. Loss ratios remain strong. Gross loss ratio was 38% and attritional loss ratio was 18% in Q2, reflecting continued pricing and underwriting discipline and a meaningful margin advantage. And finally, after selling 2.1 million Porch shares to Porch Group in Q2, the reciprocal now owns 16.2 million Porch shares, of which the majority of the value is considered non-admitted assets and incremental to statutory surplus. Okay, moving on to the balance sheet. Porch ended Q2 with $127 million in cash and investments, down slightly versus Q1. The decrease reflects the purchase of the 2.1 million Porch shares during the period, along with $17 million in interest expense and timing of working capital. And all of that partially offset by adjusted EBITDA generated in the period. As a reminder here, over time, we expect cash generated for Porch to track with adjusted EBITDA excluding the reciprocal, minus the cash interest on our notes. Q2 was consistent with that framework. Adjusted EBITDA generation largely offset the biannual interest payment and the 2.1 million share purchase from the reciprocal. On the reciprocal side, it held cash and investments of $331 million at the end of Q2. Okay, shifting now to guidance. We're raising our guidance across the board, given the strong 2Q performance and outlook for the remainder of the year, driven by insurance services. We're increasing guidance for revenue excluding the reciprocal to a range of $506 million to $517 million. The midpoint of $512 million represents a 22% year-over-year growth rate, up from the 22% growth rate that was implied in the prior guidance midpoint. We're increasing guidance for gross profit, excluding the reciprocal, to a range of $419 million to $429 million, now representing 23% growth at the midpoint, up from 18% growth at the prior midpoint. We're increasing our guidance for adjusted EBITDA, which excludes the reciprocal, to a range of $119 million to $125 million. The midpoint of $122 million represents a 59% year-over-year growth rate, up from 38% growth at the prior midpoint. Taking a step back, we started the year with adjusted EBITDA guidance of roughly $100 million at the midpoint. Halfway through the year, we've delivered $59 million of adjusted EBITDA, excluding the reciprocal. And in 6 months, we've increased our guidance by more than $20 million at the midpoint. As Matt highlighted, we expect net income attributable to Porch shareholders to be positive for the full year and on a go-forward annual basis. The trend here is clear. Adjusted EBITDA is scaling, insurance services is driving operating leverage, and the business is moving into a profitable position. Quarter to quarter, GAAP net income can still move with mark-to-market adjustments and other non-cash items, but that doesn't change the underlying trajectory. This positive net income milestone and overall earnings growth trajectory also translates to a strengthening and more durable financial profile. With our updated guidance, we expect our leverage ratio to be better than 3 times this year, consistent with the 2 to 3 times target range we discussed in our 2024 Investor Day. Now I'll hand it over to Matthew to provide a strategic update.
Thank you, Sean. I'll provide a brief operating update and then walk you through the key KPIs across our segments. Last quarter, we discussed AI, how we're using it at Porch today, how we plan to use it over time, and why we believe AI strengthens rather than threatens our position. Today, I want to give a few concrete examples of how that is starting to show up operationally. We believe our proprietary data assets become more valuable as AI capabilities mature. Our data platform gives us unique insights on approximately 90% of US residential properties and early signals into 90% of US home buyers each month. Not only does AI allow us to accelerate the breadth and depth of our data platform, we are able to leverage it to better price and predict risk. In engineering, we are seeing broad adoption of AI tooling and productivity improvements, including a 2.4 times increase in lines of code changed and a 73% increase in merge requests created. Nearly all of our engineers leverage available tools to meaningfully accelerate their work. AI is helping identify and reduce underutilized compute resources across targeted cloud compute infrastructure, with net savings approaching 10%. Across the org, AI is improving product and support capabilities. In just one example, in our moving group, we've shifted to AI-assisted call reviews, which is already having a measurable impact on conversion, and support is becoming faster, cheaper, and higher quality. These are just a few of many examples. Our company already looked at velocity as a competitive advantage versus our competitors, and the tools available only help us accelerate. Shifting gears to the Q2 insurance KPIs, the key operating story is volume growth. We continue to expand the customer base at a strong growth rate, with reciprocal policies written of approximately 59,000, growing 38% year over year. Reciprocal written premium was $140 million, and RWP per policy written was $2,383. Similar to recent quarters, RWP per policy written was down year over year, given the mix shift toward a higher percentage of new customers versus higher priced renewing customers. As Matt mentioned, the premium per new customer in Q2 declined only 4% year over year, which is the appropriate apples to apples comparison. The progress we've made in our insurance services business is clear to see in the financials and KPIs, but there's more to the story. The most important point is that insurance services is not just getting bigger, it's becoming more scalable and more efficient. We continue to make progress across the various operations that support the insurance business. On pricing and underwriting, we are continuing to improve the precision of how we select, price, and manage risk. This matters because it supports disciplined growth, helping us compete for the right policies and maintaining attractive unit economics by avoiding bad risks. Our agency experience continues to improve. Here, we've seen a 30-point improvement in NPS driven by our product investment, better support and responsiveness, and execution by our teams. We're continuing to invest in the technology behind our insurance workflows, using automation and AI to improve velocity and increase efficiency across the organization. So when you look at the quarter, the takeaway is more than the strong financial execution, but the deep investments we're making at the same time to set the business up for years of strong performance ahead. Moving to software and data and consumer services, both businesses remain tied to the US housing market, which continues to present a challenging backdrop. Our focus is straightforward: manage these businesses with discipline today while continuing to strengthen the product and partnerships for a future market recovery. Starting with the software and data KPIs, the total number of companies served was approximately 19,000. The majority of the decline was driven by the previously discussed planned sunset of a legacy product that served roughly 4,000 small home service contractors. Annualized revenue per company increased 24% year over year to $4,926, reflecting the higher mix of larger, higher value customers. In consumer services, the team continued building partnership momentum in advancing properties such as movingplace.com. For the quarter, consumer services had 84,000 monetized services, with annualized revenue per monetized service of $216, growing 7% year over year, driven by upsell and cross-sell efforts. Beyond the KPIs, we continue to make progress on the product and customer experience side of the business. In software and data, the home factors pipeline is progressing nicely with carriers of all sizes, testing the product with successful results. In the quarter, ISN launched a redesigned order form and auto provisioning for new inspectors. And last year, ISN rolled out AI defect detection, and usage has doubled across our core inspection software products. Importantly, customer satisfaction for our software products remains strong and improving. The latest NPS was 51 for inspection software, up 14% year over year, 61 for our Flow5 mortgage software, up 23%, and 71 for Rhino, up 14%. That is encouraging in any environment, but especially against a housing market that remains near cyclical trough levels. We see additional opportunity to improve product value and customer experience, which we believe can further strengthen our already strong market positions, including inspection, where we serve roughly half of the market, and title, where we have roughly 40% share. I'll now pass it back to Matt to wrap us up.
Thank you, Matthew. Okay, I want to wrap up by briefly reinforcing the most important messages from today. First, we're executing well. We exceeded expectations across the board and raised our outlook. Adjusted EBITDA, excluding the reciprocal, is now $122 million at the midpoint and $125 million at top end of guidance, driven by the very high incremental margins of our insurance services business. We are ahead of schedule in tracking to our medium-term target of $3 billion in premium, $2.3 billion in revenue, and $660 million in adjusted EBITDA, excluding the reciprocal. Second, we are pleased with the progress on growth. As we mentioned, total policies written grew 38% year over year. Insurance services similarly had 38% year over year revenue growth. The number of producing agency branches more than doubled, and statutory surplus, the reciprocal, is in a very strong position. And third, our financial profile has strengthened. We're now a rule of 50 company. Our leverage ratio is better than 3x this year, and we delivered positive net income attributable to Porch in Q2, while expecting to remain positive for the full year. With that, John, let's please open the call for questions.
Thank you. Ladies and gentlemen, we'll now begin the question and answer session. At this time, I would like to remind everyone, in order to ask a question, please press star followed by the number 1 on your telephone keypad. And if you would like to withdraw your question, press star 1 again. We'll pause for a moment to assemble the Q&A roster. Your first question comes from the line of Dan Kurnos with StoneX. Please go ahead.
Great, thanks. Good evening, everyone. Thanks for all the additional color tonight, especially Matt, refocusing on policy count. Can you just broaden your thoughts a little bit? I mean, I really appreciate the slide in terms of sort of the targeted actions you guys took. So just help us think through what you saw, how you guys reacted, and to what extent, you know, the market is dictating those choices, and when you might choose to get more aggressive or not, because you guys are in a rather enviable position from a margin perspective, and you have a lot of leeway.
Yeah, thanks. Appreciate it. Yeah, the first point that you make is just a point we wanted to land, which is, I'm not sure if you know, folks have really understood and appreciated. You know, we've talked about how we generate revenue in a few different ways. You know, management fees and policy fees as examples, but that policy fees and really the count of policies is really impactful to our financial model. And so we just wanted to make sure that was clear to folks. In terms of conversion rate, I mean, you saw it, you know, on the graph, but it is interesting to see, you know, across different market cycles, you know, conversion rates will naturally move up and down slightly. And the advantage that we have is just because we have such better loss ratios than the market, you know, we are able to, you know, to manage against that. And so I certainly was proud of the team's ability to kind of recognize, you know, changes in the elasticity curve of the conversion rates, be able to put new actions in. And again, like I mentioned, really have a fairly minor change, just that 4% year-over-year change in the premium per new customer, but to be able to respond quickly and ensure that we're managing to to the outcomes that we want to manage to for this year. I think you're right, and there's a lot of runway ahead, and as I've talked about, we want to just stack year after year after year after year of really strong, consistent growth while we're maximizing margin dollars within our growth goals, and that's the playbook that we're executing against.
And then if I could just follow up, just two secondary pieces. First, just any update on how Michigan is going, learnings there. Obviously it's going to take a while to sort of prove out the data case, but just love an update. And you mentioned it yourself. You just added a little bit more to the surplus, especially in the statutory side. You had a phenomenal 2Q, especially given timing and seasonality. Book rolls, M&A, any reason to get more aggressive, or are you, I know you just finished telling me that, you're trying to maximize margin dollars, but those all accrue, Matt, to shareholder interest. So just any thoughts there would be great.
Well, why don't I take the second one, and Matthew, maybe you can give an update on Michigan. It is your home state after all, so give you the glory there. I'm not going to answer much of your question on M&A, of course, Dan, but I will say that there are lots of interesting opportunities. Our corporate development team is never been busier. It's part of our playbook, and so what just to be super clear, what we're managing to and what we've talked about in terms of our goals this year, those are our pure organic goals. So if we're to do anything else, that would sit on top, certainly in terms of what we'd look to do, and more to come as in the right time, certainly if there's something to share. But Matthew, you want to hit on Michigan?
Yeah. I think we're excited about Michigan. We're excited about any new state expansion. You're right, it does take time, but our team is focused on growing distribution there. So there's lots of opportunity for us around agencies, and we're getting them appointed. We're starting to see quote flow. The other thing I would say about the data that's interesting is we're now smart enough with our data that even if we don't have data on a home, we have enough data in related homes that we can start to infer things about homes. The reason why that gets important is when you're heading into a new state, there's always an amount of time where you're learning about how risk behaves in those homes. And you accumulate that over time by getting more claims data and working with more customers. We think we'll have sort of an advanced start because of our data based on kind of what we've been seeing in our modeling.
Got it. Thank you guys very much, and well done.
Thanks, Dan.
Our next question comes from the line of Jason Helfstein with Oppenheimer. Please go ahead.
Thanks. So this is now 2 solid quarters of very nice take rate. Can you just talk about, is this the new normal, and how mix kind of plays into the take rate? And then secondly, I think that the rest of the industry, or just in general, right, the industry is kind of losing the pricing tailwind, but yet it doesn't seem to kind of impact your efficiency on marketing for a lot of the reasons that you've talked about, and we all know. Just maybe talk about how you think, that dynamic, that kind of change in the industry kind of impacts your ability to be efficient adding policies. Thanks.
Sean, why don't you take the first, and I can layer in with the second?
Yeah, sure. For the take rate context there for folks, sometimes folks think of the insurance services revenue as a percentage of RWP as effectively the take rate. So I think that was the question there from Jason. That percentage was 66% in Q2. It was 65% in Q1. So Jason, I think your commentary there, we have seen it now for a couple of quarters sustain at that higher mark. We're pleased with that conversion, both into insurance services revenue and ultimately into adjusted EBITDA, given the relatively fixed cost base that's creating a lot of earnings. And so, something in that 60 to 65% range is kind of the area we've seen it over the last couple of quarters. And the last thing I guess I would just say there mechanically, just so also, last year was our first, I mentioned this in the prepared remarks, but we are seeing some deferred revenue flowing through into that, and we expect that to continue ongoing. I mentioned that last year was the first year under the reciprocal structure, and so some of the fees get deferred, and so that's coming in this year, and that'll continue. We'll expect that to continue, obviously, in future years as well.
And then on the second one, maybe just high level quick, because Jason on it is, fundamentally what I think this game is around is, if one can be able to better assess, predict, and price risk, fundamentally you'll win. And I think we've clearly demonstrated over a extended period of time now that that we have abilities to be able to produce lower loss ratios than others do. And with lower loss ratios and low attritional loss ratios, it just means that there's more margin in the system overall. And then you can choose how you want to deploy the margin. You can be able to, obviously we have very healthy flow through in terms of Porch Group EBITDA. We obviously are growing the capital base at the reciprocal really effectively. You're able to allocate to a really healthy reinsurance program to make sure the reciprocal is protected. But then you can also use it for growth. And we effectively put a little bit of the margin back to customers via that 4% decline in premium per new customer, and through that you're able to control and impact those conversion rates, which in turn help us to be able to grow faster, grow policy count faster. And so that is a great position to be in, where we can manage this margin advantage that we have to be able to produce the outcomes that are going to create shareholder value over time.
Our next question comes from the line of Matt Bentley to Cantor Fitzgerald. Please go ahead.
Hi, this is Mason Marion on for Matt. Thanks for taking our questions here. So your proprietary data is one of your real competitive advantages. You kind of talked it on the call, but how is AI helping you further expand this advantage? Are you leveraging your home inspection data in any new or interesting ways today compared to, say, maybe the beginning of the year?
Yeah. So one of the
Go ahead, Aaron. Go ahead. You got it.
So we do have a large set of proprietary data, and we continue to look for different attributes or conditions of homes that we think could be predicted of risk, and we call those home factors. And so we're now up to 100 home factors. So we continue to build out insights from the data that we have. In terms of AI, I would highlight a couple of things. Our ability to go model and identify those home factors is getting faster. And so we're able to get through building out all of the different insights we think are within our data more quickly. I think the other things, there are certain types of data, particularly around visual information, which before felt very hard to go and extract insights from, are now becoming much more reachable with AI. And so that just allows us to go deeper into the data to build out these home factors that help our business, and we think will help other insurance businesses.
Then maybe a modeling one here to follow up. So your EBITDA guide, if I'm doing my math right here, you raised it by about 16 million, while revenue was raised by about 11 million. I mean, you have really strong incremental margins. Can you kind of talk to where you're seeing really strong leverage and how that factored into the guidance?
Yeah, sure. Maybe I'll start with the results in the second quarter here. You could see it really clearly in insurance services adjusted EBITDA. If you look at the segment, the costs are relatively fixed. I think this has been part of the story that we've been telling for many quarters now, and I think this quarter was just a great example where the numbers are clearly showing that as also, and we've seen that in prior quarters as well. But it's 38% growth in policies written and relatively fixed costs. I did mention there's a $3 million non-recurring benefit in this period, so make sure we account for that. But the margins are phenomenal, and so obviously we're pleased today to continue to increase our guidance. In the last 6 months, we've increased our adjusted EBITDA guidance by over $20 million and are now guiding to $122 million at the midpoint. We're very pleased with how the year is progressing, and we're excited.
Thank you.
Thank you.
Our next question comes from the line of Ryan Tomasello with KBW. Please go ahead.
Hi, everyone. On the revised guidance, can you say what that is now baking in for reciprocal written premium for the full year and in the second half, whether or not we're now talking about something north of $600 million, which is what I believe you initially set out to achieve to start the year?
Yeah, the target on RWP is $600 million. Let me maybe provide some context and break that down for folks. We're halfway through the year. We've done $255 million of RWP. That means in the second half of the year, we're expecting $345 million of RWP. We talked about on the call today, policy growth has been fantastic, and we're seeing a lot of volume, and we expect volume to continue to ramp sequentially, ending the year with more than 70,000 policies per quarter, written per quarter. So those are some of the components to it. If you put that in context, in Q2, we wrote just under 60,000 policies, and we'll continue to increase the policies written with the things that have been working very well for us. Top of funnel distribution, continuing to add agents using our land and expand approach, conversion with targeted actions, some of the things that we saw today that have been working quite well.
I guess given the momentum you've seen in the first half, is there potentially some offsets to that are reducing the upside to that $600 million for the full year? Why the second half isn't baking in more upside? Just trying to understand the moving pieces here, just given how strong the results have been thus far and the guide up, despite the RWP guide seemingly unchanged.
Well, again, it's one of the messages I was trying to land, Ryan, just to make sure it's clear. We're obviously managing to our financial results in terms of kind of what we want to deliver. And certainly you see that just with how we're executing, against that, obviously with, both the beat today and the substantial, raise. The thing, again, I think people have been very focused on just an RWP, but our economic model is driven through both RWP and policies written. And we just want to make sure that's clear. We charge policy fees to every new and renewing, policyholder. And so that is a way that we generate money. And so you really have to look at both of those two things. Policy growth is, as we talked about today several times, is growing very, very rapidly. And so we can balance those two things, how fast we want to grow the total premium and how fast we're going to grow the policies at the end of the day to be able to accomplish our organic, growth goals for our business. And that's the way that we'll approach it.
Okay, that's helpful. Thank you.
Yep.
Our next question comes from the line of Timothy D'Agostino with B. Riley Securities. Please go ahead.
Hi, good evening. Thanks for taking all the questions. I just quickly on my end, it'd be great to just get some color on the products, the legacy product and the Porch Insurance product. For RWP from new customers, obviously tripled year over year. Are you seeing a lot of interest and demand for the new product, or is it still towards that legacy product? And then as well for the branch growth, do you see new branches that come online? Are they interacting with that new product more? Any color around that would be great. Thank you.
Yeah, I mean, by definition, obviously, in the way that just insurance works, the vast majority of policies are going to be, with our legacy Homeowners of America product because it has all of the renewing customers, on it. And so we are excited about Porch Insurance and the value prop. As a reminder, it's only launched in one state as well. And so even in that one state, you have to go and ramp up the number of agencies that are they're able to sell and distribute it. So when you launch a new product, it does take time to ramp both within that state, across more states, and then to start building a renewal, base. But, we continue to be excited about, fundamentally offering a different product to consumers, being able to bring a full home warranty, being able to bring 4 hours of moving service. Like, we do want to be known as providing the best product for a home buyer, period, full stop. And we've got unique capabilities in our consumer services area to be able to do that. But it's early days, just given kind of how the model works, like I described.
All right, thank you so much.
You bet.
Our next question comes from the line of Oscar. Go ahead. Mr. Oscar Nieves, your line is open. Please go ahead. In the meantime, we'll move on to our next question. Our next question comes from the line of Jason Kreyer with Craig-Hallum. Please go ahead.
Thank you, guys. So in the quarter, you kind of had the first transaction to monetize some of the shares held inside of the reciprocal. Just curious, how should we think about the other 16 million shares and what your strategy is going to be there over the coming quarters or the coming years?
Obviously, we're excited about where the value of a share is going to go, over time. As we said before publicly, there's, our view of intrinsic value is certainly different than where the shares are today. And we think as we just keep stacking quarters and just executing like we are, that gap shrinks. And so, there will be a time in the future where it's going to make sense to start selling some small portion of shares, at the reciprocal to move, some of the capital from non-admitted assets into statutory surplus. We talked about that being part of the playbook, that we have, but we're in no hurry. Obviously, we have so much capital at the reciprocal to be able to support far more premium growth than we're tracking for this year. We want to continue to maintain, a nice, healthy margin of excess capital, and so we'll just manage the business to make sure that we're accomplishing that.
Don't disagree with your assessment on the value of shares. Just as a follow-up, Matt, at the end of the quarter, I think the reciprocal secured a $100 million cat bond. Can you just talk about what that means for the health of the reciprocal and if there's any anticipated cost savings on reinsurance coming out of that cat bond? Thanks.
Yeah, I can cover that one. And just for context for folks, a cat bond is a type of fully collateralized reinsurance. We placed it at the very top of the reinsurance tower, so it's covering very, very low likelihood events. But given the growth that we're seeing at the reciprocal, we thought it was prudent to ensure we were adding that. It was our inaugural cat bond offering for the reciprocal, and we were very pleased with the outcome. We partnered with a very strong slate of investors there, so I want to give a nod to those folks as well. But overall, we think it's an attractive instrument and an attractive way to procure reinsurance.
All right. Thank you.
And our next question comes from the line of Oscar Nieves with Stephens Inc. Please go ahead.
Hey guys, sorry about earlier. I was having some technical difficulties.
No problem.
My first question is, you highlighted that new customer RWP grew 206% year over year, while total RWP grew 16%. So should investors expect that gap to persist, or will renewal growth become a larger contributor over time?
Well, we expect new customer growth will continue. Obviously, we have a really healthy engine as we continue to add more agencies, and then have agencies deliver more quotes and be able to have those quotes convert into into policies. So, like we talked about, we expect the number of new policies to continue to grow, here as we continue, forward. It's a beautiful game, insurances, which customers renew at a really, really high clip. And the vast majority of customers, pay with escrow, and it's just a very sticky product, fundamentally. And so we're not commenting on like the mix and how we expect the mix to transition, over time. But certainly I can give you that comment, which is, we certainly expect new customers will continue to grow quickly, and those customers do become long-term customers, generally, where the price per customer will tick up, year after year after year as they renew. That's quite common.
All right, that's super helpful. And then my second one is on statutory surplus, which you mentioned increased to close to 170 million. So how should we think about the relationship between surplus growth and premium growth over the next, say, 12 to 24 months?
Yeah, I can take that one. So we're quite pleased with where the statutory surplus is, $170 million at the end of Q2. This year to date, it's up $15 million. And especially just having gone through the quarter with the highest weather claims typically, that's a great place to be, and better than what I would have expected starting the year. And so we're certainly pleased with that outcome. The kind of base requirement that we've historically talked about is a 5-to-1 RWP to surplus, and actually in some of the prior quarters we've talked about it actually being a little bit better than that now. But those are some of the guardrails that folks can think about there. But I would say, very pleased with the statutory surplus and the loss ratios and just the underwriting discipline and how the reciprocal is performing.
Thank you. Very helpful.
Thank you, and that concludes our Q&A session for today. I would now like to turn the call back over to Matt Ehrlichman for closing remarks.
I appreciate it. Appreciate everybody being on the call. Thanks for the questions. I think you can get a feel for the energy. We remain very confident in where we're at and how we are executing. I mean, it is fun now to be a rule of 50 company. Feel really good about our leverage, being better than 3x, this year. We're just making strong progress, and certainly now being net income, positive, this year, all great markers, for us. We believe, and again, feel very confident we've constructed a durable model with significant opportunity where we can scale a premium and convert that premium into high margin earnings, and continue to add products and capabilities, that set us up to go after this $200 billion TAM, with just fundamental advantages. Lastly, core thing we talk about is creating long-term shareholder value for shareholders as part of building a truly great and enduring company. And so certainly just rest assured that that's what we are focused on, and I think making great progress against each day. With that, we'll close the call. Have a great rest of the day. Take care, everybody.
Ladies and gentlemen, that concludes today's call. You may now disconnect.
판매 성공.
깜짝이야. 나부터 빨간불에.
다행이야. 아우,
그럼 트럭이 먼저 우회전하고 나도 이제 우회전해요.
오나 봐.
주행 넘겼어.
어떡해.
빵 하니까 놀래가서
아이고.
아이고 바닥으로 떨어졌어.
중학생 2명이 헬멧도 없이 공중에서 2바퀴를 돌고 아스팔트 위에 그대로 머리부터 떨어지며 죽지는 않았지만 심각한 뇌손상이 예상되는 가운데 킥보드와 직접 부딪힌 흰색 차량 여성 차주의 트라우마 그리고 블랙박스 차주의 트라우마 역시 굉장히 우려되는데요. 할 말을 잃게 만든 사고였습니다.
안녕하세요, K입니다. 요즘 헬멧도 없이 막 킥보드 타고 다니면서 도로 인도 구분 없이 마구잡이로 타고 다니는 그런 아이들 참 많죠. 일명 킥난이, 이른바 킥난이라고 불리우는 이들은 지침상 헬멧과 면허가 필수입니다. 그런데 얼마 전 인천에서 킥보드를 타던 아이들의 팔을 낚아채 세우려다가 아이가 크게 다치는 일이 벌어졌습니다. 그런데 이게 지금 과잉 진압이다 아니다 이런 논란이 있던데 영상부터 빠르게 한번 보시죠. 인천 부평의 한 도로에서 인도를 빠르게 달리던 킥보드 한 대가 갑자기 고꾸라집니다. 영상을 자세히 보시면 경찰이 킥보드를 타고 달리던 10대 학생 팔을 잡아 끌면서 불법으로 타고 있던 학생 2명이 길바닥에 넘어진 것이죠. 앞에서 운전하던 아이는 멀쩡하게 툴툴 털고 일어났지만 뒤에 있던 아이가 몸을 부르르 떨며 발작을 일으켰는데요. 그에 놀란 경찰이 심폐소생술을 실시한 뒤 응급실로 이동, 진단 결과는 뇌출혈과 2개 뇌골절. 이틀 뒤 출혈은 잡혔고 열흘 만에 퇴원했습니다. 영상 보시면 아시겠지만 킥보드를 타고 불법으로 인도를 달리던 학생들은 모두 15세로 한 명도 아닌 2명이 탔던 것도 문제지만 관련 면허조차 없었던 위법 그 자체였던 것으로 보입니다. 딱 봐도 경찰의 과잉 단속으로 뇌출혈이 발생했다라기보다는 애초에 법으로 정해졌던 헬멧을 착용하지 않아 뇌출혈이 온 것으로 보이는데요. 무면허의 인도주행, 장구 미착용, 심지어 2명 탑승. 이 구성만 봐도 어질어질한데 집에서 교육을 좀 더 잘 시켰다면 이런 문제가 없었지 않았을까요?
컨테이너 박스에 앉아 있다가 애들이 오는 경로를 보고 갑자기 튀어나와 잡은 걸로 보여요. 하이바 안 쓰고 동승한 건 잘못이라고 생각을 하는데 경찰분이 이렇게까지 단속을 해서 애들을 다치게 해야 됐었나.
잘못한 건 알지만 이렇게까지 단속을 했어야 됐나 식의 학부모의 인터뷰가 담겼습니다. 물론 일반적인 부모의 입장이라면 아이를 위해서 걱정하는 마음 10분 이해합니다. 다만 위법 행위를 한 사람의 가족이 할 이야기와는 다소 거리가 있다랄까요. 누가 봐도 규정과 질서를 어기고 범죄를 저질렀는데 두둔하는 것처럼 보일 수 있다는 겁니다. 실제 이와 비슷한 사건이 최근 일산 호수공원 산책로에서 여고생 2명이 타던 킥보드로 노부부를 찧어 사망에 이르게 만든 사건도 있었죠. 심지어 이와 비슷한 불법 킥보드로 인한 사망 사건은 세종시에서도 최근 있었으니 절대 잊지 말아야 될, 그리고 가볍게 결코 쉽게 보지 말아야 될 사건으로 보이는데요. 이 단체의 의견만 그런 게 아니라 해당 영상에 달린 댓글 여론만 봐도 유사했습니다. 경찰이 할 일을 한 것인데 되려 불쌍한 처지에 놓였다. 뭔가 피해자랑 피의자가 바뀐 것 같다. 단속은 정당했고 학부모는 아이들 교육을 다시 시켜라. 저런 게 과잉 단속이면 범법자들이 활개치고 다니는 그 모습을 그냥 놔두란 말인가. 가정교육을 똑바로 시키지 않을 거면 처음부터 집 밖으로 내보내지 마라 등 일침을 가하는 글들이 도배가 되었습니다. 게다가 단속 경찰은 갑자기 제지한 게 아니라 미리 정차 지시를 했었다며 학생 2명이 면허도 없이 도로교통법도 모르는 상태에서 인도에서 빠르게 달리고 있어 보행자에게 위험이 될 수 있는 상황이었다며 절대 과잉 단속이 아니었다라는 주장을 하고 있습니다. 경찰청 역시 객관적인 기준만으로 판단할 수 없고 이 직전 상황의 위법성과 제지의 필요성 등 구체적인 당시 상황에 따라 다르게 판단할 수밖에 없었다라고 설명했는데요. 다만 경찰청 교통단속 지침엔 교통법규를 위반한 차량에 단속하고자 할 때는 차량 통행 및 안전에 유의해 안전한 장소로 유도, 정차시킨 뒤 단속을 해야 된다라는 내용이 있긴 합니다. 불법 킥보드 운전 학생 측 학부모는 해당 경찰을 업무상 과실치사로 고소하고 과잉 진압에 대한 국가배상 소송까지 진행할 예정이라고 하는데요. 애초에 불법은 킥보드 운전자가 저질렀는데 국가에게 배상을 청구한다? 이런 게 과잉이면 대체 경찰은 앞으로 뭘 할 수 있을까요? 그리고 학생 2명 때문에 인도에 있던 사람들이 만약에 다쳤다면 학부모는 똑같은 말을 했을까요? 하지 말라고 한 거 처음부터 안 했다며 경찰들도 잡을 일이 없었던 거 아닙니까? 무조건 경찰 탓으로 몰아가기에는 상식 밖이고요. 무엇보다 국가 배상을 요구한다는 건 이건 더욱더 상식 밖이라는 의견이 다수입니다. 그리고 혹시라도 헬멧도 면허도 없이 인도에서 불법으로 킥보드 몰고 가다가 다른 보행자라도 치고 넘어뜨려서 그 사람 뇌출혈 사고 당하기 전 경찰이 제지한 것으로 봐도 무방하지 않나요? 그냥 제 착각일까요?
또 하나 이 사건을 직접 목격했던 분께서 남긴 듯한 글도 있었는데요. 현장에 있던 아이스크림 가게 사장입니다. 당시에 킥보드가 너무 빠르게 인도로 달려서 경찰이 위험하니까 정차하라고 3차례 요구했는데 애들이 짭세다 조롱하면서 지나가고 다시 정차하라고 했을 때 그냥 가길래 교통경찰이 살짝 잡았는데 법규 어기고 2명이 탄 거라 무게중심 잃고 넘어진 겁니다. 심지어 헬멧도 안 쓰고 무면허를 하는데 과잉 단속으로 여론몰이 하려고 하는 건 아휴, 또 다른 역시 헬멧을 착용해야 하는 이유를 가르쳐준 수업료로 생각해야지. 저런 걸 과잉 대응이라고 하면 안 될 듯하고 저것까지 문제 삼는다면 무고로 엄하게 대처해야 된다. 하늘나라 갈 각오로 저렇게 타는 거 아니었어? 부모 참 뻔뻔하네. 저런 고소는 안 받아줘야지. 경찰관은 무슨 죄냐? 와 같은 이야기들도 있었습니다.
만약에 제가 부모였다면 자식을 잘못 키운 제 탓입니다. 고개 숙여 사과드리겠습니다. 라고 하면 될 것 같은데 이게 잘 사람마다 안 되나 봅니다. 그리고 경찰이 하는 모든 행위에 이렇게 태클을 걸게 놔둬버리면 누가 수사하고 방어하고 내가 신고했을 때 출동하고 시민을 지켜줄까요? 모든 일을 국가에서 보상해주고 충실하게 임무를 수행한 경찰에게는 사기를 돋궈주며 정당한 공권력이 위축되는 일이 발생하지 않도록 해줘야 되는 건 역시 국민의 몫이라고 생각되고요. 그렇지 않게 되면 그 피해는 고스란히 다른 선량한 피해자들, 즉 국민이 보게 될 겁니다. 어느 지역이라고 말하진 않겠지만 4년 전 빌라 사건 살인 때 피해자가 뻔히 보이는데도 도망쳤던 남녀 경찰, 적어도 그들처럼 되는 일은 막아야겠죠. 3년 전에도 자기 집에 불났다고 신고해놓고 출동했던 119 소방대원이 진화를 위해 창문을 깼고 불길이 다 잡히자 며칠 뒤 유리컵 내놓으라고 왜 자기 집에 망치질했냐고 오히려 소송 걸었던 한 시민이 떠오르는군요. 자기 집 불 꺼주러 온 소방관들에게 고마움을 전하지 못할 망정, 그게 무슨 짓입니까? 성인 군자는 바라지도 않으니까 인간답게 좀 사는 건 어려운 일일까요?
인터넷 가입 아정당에서 했어?
아니 딴
정수기도 아정당.
이사 청소 아무 데서나 해도
다쳐가지고 뇌출혈 증상으로 입원했던 아이가 퇴원했다고 하니 참 다행스러운 일입니다.
얼마 전 보배드림에 눈살을 찌푸리게 하는 사진 하나가 등장했는데 엘리베이터 안에 킥보드 한 대가 덩그러니 놓여 있었.
식어가고 말은 더 늦어져 끝내 못한 그 한마디가 내 목에 걸려 괜찮다고 말하면 정말 괜찮아질까 서랍 속에 접어둔 이름 자꾸만 젖어 네가 떠난 그 밤에 내 시계도 멈춰 아무도 모르게 나는 조금씩 무너져 나는 아직 여기야 너만 없는 자리야 젖은 우산 끝에 남은 건 나야 부르면 닿을까봐 또 입술을 물어 나는 아직 여기야 너만 없는 자리야 너만 없는 자리야 편지처럼 구겨진 내 하루를 펴면 네가 웃던 장면들만 또 선명해져 창문을 두드리는 빗소리 틈마다 네 이름 하나씩 떨어져 밤을 적셔 괜찮다고 말하면 정말 괜찮아질까 가슴 한쪽 깊은 곳엔 아직 네가 살아